I'm delighted to welcome you all to our fourth lecture of the NBS-PRI-ECGI Public Lecture Series on Sustainable Business. My name is Yuxia, and I'm assistant professor here at Nanyang Business School at NTU Singapore. I have the privilege of representing the organizing committee as your MC for today. The NBS-PRI-ECGI Public Lecture Series on Sustainable Business is a global new initiative starting in 2025, aiming to facilitate knowledge exchanges among academics, practitioners, and policymakers in the field of sustainable business. Every month, we'll have a public lecture, either in person here at Gaia with global live stream via Zoom or virtually via Zoom. So each lecture will feature a leading academic to present an overview of academic research focusing on a specific topic in sustainable business for around 60 minutes, followed by a 30-minute Q&A moderated by an industry expert to connect academic insights with practitioner experience. After each event, we'll summarize the content in a blog post to be shared online together with the recordings to create a public library available for all. This year, we'll have a very exceptional lineup with renowned academics across various disciplines, hoping to encourage interdisciplinary dialogues and also collaborations, hoping to tackle sustainability issues with a more holistic perspective. So to start off our event today, it's my honor to invite our NBS Associate Dean in Research, Professor Chang or Simba, to deliver his opening remarks. Simba, please.
Okay, good evening, everyone. Very warm welcome to people who are joining us here at the auditorium, and also to those tuning in online from Singapore and all over the world. This public lecture is part of a collaboration among Nanyang Business School, the UN-supported Principles for Responsible Investment, and the European Corporate Governance Institute. So we are very pleased to continue to share the effort to deepen our conversations around sustainable business and finance. As a business school within a leading technological university, NBS sits at the intersection of business and technology. We take an interdisciplinary approach to innovation, nurture culturally agile leaders, and focus on creating long-lasting impact through sustainability. So this perspective shapes how we do research, how we teach, and how we engage with partners. And this particular lecture series reflects this broader commitment. Each month, we bring together academic experts and experienced practitioners to exchange ideas and challenge the existing assumptions. In the first three sessions of this series, we explored sustainability through the lenses of finance and law, starting with Professor Laura Starks on climate risk and financial market, followed by Professor Pedro Matters on ESG investing, and most recently, Professor Madison Condon on universal ownership and systematic stewardship. In case you have missed any of these sessions, don't worry, because we have all the recordings and summary still available on YouTube and also on the ECGI blog. So tonight, we are very pleased to welcome Professor Rodolphe Durand from HEC Paris. His lecture, Double Materiality, Underlying Ethical Principles for Investing and Performance, look at how conventional investment frameworks can sometimes miss the broader effects of firm-level decisions. And he will examine how a more holistic understanding of risk might better reflect the interconnected systems that businesses operate in, from environmental and material context to geopolitical shifts. Moderating the discussion is Mr. Kenneth, Head of Sustainability at Civiora and Director of ESG Management at Seatown Holdings. We are very grateful for his presence and the perspective he will bring into the discussion. So thank you all once again for being here. But we hope tonight's discussion and exchange of ideas will spark new ideas and practical insights for all of us. With that, I guess I will hand the floor back to Yuxia to get us through the rest of the evening. Okay. Thank you.
Thank you, Professor Simba, for your very warm welcome and also the setting the stage for our event today. So today, we are going to look at the sustainable investment in the field of strategy and management, guided by Professor Rodolphe Durand from HEC Paris. Professor Rodolphe, probably known to many as Rudy, is the Joly Family Chair Professor of Purposeful Leadership and the founder of the Society and Organizations Institute at HEC Paris. Beyond HEC Paris, he also holds many influential roles, such as the member of PRI's Academic Network Advisory Committee, board members in the private sector, which I believe he will mention as case studies in his lecture later, and also leadership roles of academic organizations, such as the Alliance for Research on Corporate Sustainability, which he will also chair this year's annual conference in Paris this June. So Professor Rodolphe's research bridges sociology, philosophy, and also management, and centers around the question of how firms define their purpose and respond to the challenges in environmental and social issues nowadays. So his work has been published in all the top journals in management and sociology, in books, and has won numerous awards, such as the R-Scored Award from the American Sociological Association, the Responsible Research in Management Award, and was inducted fellow of the Strategic Management Society in 2014. So after the lecture later, we will have a 30-minute Q&A discussion. Some of you have already submitted your questions upon registration, which we greatly appreciate. So if you have any questions later during the lecture, you are very welcome to ask them later, either by raising your hand if you are here in person, or submitting them via the QR code on the screen. So, and our moderator will try his best to address as many questions as possible. So now, Professor Rodolphe, the floor is yours.
Thank you so much. It's a really great honor for me just to be here with you. I would like just to thank, of course, the UNPRI, ECGI, and NTU NBS for the kind invitation. I'd like just to start this by making a few remarks, and I call it a prolegomena, which is basically the starting positions that I will be taking for this talk. Well, these two starting positions are as follows. So I hope that you will be, at least for the time of this conversation, accepting them. The first one is that there is no planet B, and the geophysical changes that we are all seeing are neither reversible nor linear. And so, of course, in the investment world, that has some implications. And the second one is that any system of economic valuation is value-ridden. That means that it expresses underlying moral principles. Oftentimes, we do not have to expose them to make them explicit, except under certain circumstances when some crises make us actually elaborate more on them and question them, and therefore see that they probably need to be changed. So these are my two prolegomena for today, and I will go back to them. The outline of this presentation will be in three stages. The first one is that I will try to make a connection between double materiality. Maybe some of you are familiar with this notion, which has been more sort of a European notion that has been used. And I will try to connect it with risk-adjusted return, which is, of course, the golden standard for making investments. Then I will try to connect this risk-adjusted return with a term which is ecological fallacy, referring to one of the papers that I co-authored recently, and that led to some controversy, so to speak, or debate, let's say, in the field of strategic management. And finally, I would like just to try to provide some evidence from many colleagues' works that there are some weak signals for shifting the underlying values in firm valuation. And so you see here that I bracketed not so it's not so weak signals for shifting underlying, and I bracketed moral, or in the prior title it was ethical, values in firm valuation. So let's see if we can go over this content together. And I, of course, will be happy with Kenneth to answer to your questions, whatever they may be. So first, double materiality and risk-adjusted return. So what do I have in mind here? So, I mean, this will not be perhaps so novel for you to see, and here I'm drawing on actually this work on planetary health index, that we are reaching the high-risk line. Say, well, what is the high-risk line? Well, the high-risk line is, if you look at the planetary boundaries, you see here in this recent actually evaluation of where we stand in these planetary boundaries, that for several we cross the line. This red vertical line that you may see on your screen is actually what they refer as the high-risk line. So that means that for many of these planetary boundaries, we are borderline or cross the line for some systemic changes, which means that we will not revert back to the equilibria that we knew before, but we'll go to new sort of equilibria. So this is another representation of the planetary boundaries, and you see that you have these features, around it. What are they? They are the tipping points. So the tipping points means that once you have crossed this tipping point, a system doesn't reach back to the former state, but to a new state. It can take years or decades or more, of course, just to reach a new state and of equilibrium. And this different planetary boundaries, as you see, are connected to multiple tipping points. So when you think about the planetary boundaries, it's not just one line that you crossed. It's a trigger for multiple tipping points that will lead to different type of equilibria. So this concerns life on the ground, on Earth. It can be in the water, in the oceans. It can be the mussels. It can be the drought, etc. So biological systems that are changing. So why is this important? Well, it's important because basically what's happening is that the economic exchanges, if you think from some raw materials, but if you think of the food that we eat, if you think of some necessary minerals that we need as well to dig from the earth, actually these economic exchanges and the growth, economic growth, depend on the biophysical exchanges. So this is undeniable. And then that means also that if we start having these exchanges as being non-stable or reaching a new equilibria, that means that the firms that operate from the agro-food until any other kind of economic exchange, technological or not, actually will suffer. That means that they would have volatility in their valuation. And if you apply the first principle, which is that there is no reversible, so that's why I rarely use the term resilience, because resilience means that you go back to the former state. We are not talking about resilience here anymore. Because these changes are non-reversible, they are non-linear, that probably means that the valuation of the economic activities in the short future cannot but integrate contributions to risk related to these biophysical exchanges, geobiophysical exchanges. So we will have to integrate this in a way or another. Because if not, the forecast we have, the economic valuation, the free cash flow, the discount rates, talk any economic or financial language you may want, will not be accurate anymore. And okay, so there has been like lots of efforts just to try to access an evaluation of these risks of a different kind that were not so present, let's say, in the past century. And here you have a list of all these logos from the TCFD, the EFRAG in Europe, or IFRS, or name it, ISSB these days, that try just to promote this climate and other standards for helping firms to assess the risk that these changes in the climate or beyond actually may raise for their activities. And so that's true that this is clearly not perfect, right? It doesn't quite work so well. So already in 2016, with colleagues, we published an article that was showing that the correlation across 6 different raters that were trying to assess sustainability and ESG actually were correlated below 50%. Actually, what we had at the time was 38%. And probably you know actually a paper that actually builds and on this work, which shows exactly the same thing, which is that there is actually divergence across the raters. So this paper is much more recent, and it shows that the measurement errors or the measurement differences contribute for 56% of the difference across raters. So we are facing a problem here. Of course, it's difficult for us to assess these geo-biophysical risks in firms' valuation. So if you add the second element here, that any system of economic valuation is value-ridden, sometimes unknowingly, or we don't need every morning just to reassess and to make explicit these underlying assumptions. That means that in this current period, these attempts at assessing the sustainability impacts of firms' activities, of corporate activities or investing activities, actually are questioning these assumptions even more. And double materiality is actually a try, I would say, just to combine and to these indicators and to make them compatible with the assessment of the economic performance of economic activity, of the economic performance of firms, right? So in this diagram that I took from a provider actually of information and sustainability, you see on the left the financial materiality, which is like the single materiality. Sometimes we refer to this as single materiality, which is the risk that the environment, to speak broadly, represents for the firm's actions and the firm value. And ISSB is actually a standard for making things explicit for the market. And on the right side, the impact materiality is actually the actions that the firms have on biodiversity, on exhaustion of certain resources, etc. And what I would like to try to convey is that this double materiality actually is an attempt to create the conditions for market evaluation, so from finance and strategy, so from the investment world and from the strategy world. So to create the conditions for market evaluation of a broadened risk-adjusted return function. So that means that in the risk-adjusted return function, we will have to incorporate, I think, as time passes, more and more of these effects, of these impacts that firms have on the natural environment, based on a more systemic, quote-unquote, considerations. So that's my first point. The first point I wanted to make with you. And you see here this quote is that, you know, I don't think that breaking the thermometer will actually hide the fever. So the temperature will keep, you know, increasing, and this metaphor is worth, is worthy for any other elements from the planetary boundaries that you want to consider. So we need to measure that. We need thermometers. The ones we currently have are far from perfect. But for me, I see this as one step toward actually a better evaluation and a better consideration of the risk-adjusted return function. That was my first point. Second point, and you see here a term which is ecological fallacy. So maybe for some of you it rings a bell, maybe for others it does not. So let me explain to you what I mean here. And I will start with actually this controversy that happened in the Journal of Management Studies, which is this article. It's called a point-counterpoint. So that means that we present some arguments and some authors actually comment or disagree with what we say. And this article that has been actually co-authored with Tima Bounsal, Marcus Koger, Sven Kunich, and Anita Magan, what we say that the strategy field is actually the discipline that tries to assess, evaluate, and determine how firms can deliver a competitive advantage over their rivals. So this strategy field, actually, we said, cannot ignore anymore the planetary boundaries. And so we said it's a call for tackling the strategy's ecological fallacy. Okay, so I give you the context. Here you see that actually some of our friends and colleagues said, well, actually, we disagree. I mean, can strategy address the climate crisis without losing its essence? Probably not possible. We even had Nikolai Foss and Peter Klein say, do we need a new strategy paradigm? No. The markets, the tools we have are enough. The markets will actually regulate this through, price differences. We just adjust the value through market mechanisms. Well. What we say, it's a bit different. We say probably not. We disagree on that. So this ecological fallacy, what does it mean? So of course, when you hear ecological, probably you have this second meaning that comes to your mind first. Ecological as natural environment related to natural environment, right? But let me start with the first meaning of the term, which is actually ecological in the sense of species in their natural environment, the individual relative to the species composition, for instance, or the individual related to a group effect. Let me illustrate this for you. Okay. So technically, ecological fallacy in econometrics or in statistics or in many different sciences, especially ethology, is when you infer characteristics of behaviors of individual units based on aggregate data. So in the case of management, you look at industries and say, oh, the more the industry does that, the better the performance, right? What could happen is that actually the firms would locate themselves in the plan that you are representing a bit differently as they belong to different groups. So the key risk associated with ecological fallacy is that actually you tend to take the group trends as a truth for what is happening with individuals. So let me be even more explicit. An example. So for instance, you say that industries with high average R&D tend to have higher profit margins. And as an investor, you invest more in biopharmaceuticals or in AI or any other kind of new technology related, right? Because they would get more profit margins. And so therefore, one might infer that any firm spending more R&D will also be more profitable, right? The problem with this is that this ignores variation among firms within the industry. And it could be the fact that other factors will actually be part of that equation. In that scale, strategy, market power may drive both R&D and profit, typical problem. So therefore, many firms in this industry may still perform poorly despite high R&D. So let me show you this in a graph. So imagine that you see the R&D spending in the x-axis, the performance in the y-axis. You see here that you have actually green crosses that would represent average performance of different industries. And when you look at this, you say, hey, it's better for me just to invest in the upper right industries because this is where I will get the most profit, right? However, if you look at the populations of firms, individual firms that enable you to, create the averages, it might be that it's a virtual example that actually, if you look at this individually, each firm for these different industries may look a bit differently. So that means the average could mask the effect that it's not necessarily true that for a given industry, the most performing firm will be the one that will spend more R&D. You see that here in these cases, you have for a given set, actually the leftward individual from the group which has a higher profitability than the one that is on the right of the same subset. So this is what is happening is that you could make some investment based on actually a firm R&D, in that case, R&D investment, and you will over-invest on these companies based on a false attribution that you will get and you have gotten through the industry averages, right? For a policy implication that you will base or create incentives for some industries that may not benefit to all firms equally and probably actually will be also a poor allocation of your resources. Okay, so now that I have defined this first term of ecological fallacy, the first meaning of the term, let me show you something from the text. So the technical term for this differences between individual and group level effects can make us think in this paper that basically when we maximize, so when we define the competitive advantage of the firm, when we maximize the total rents or the value that is generated at the firm level, perhaps actually we are misleading actually the decision makers because we may not maximizing the value at the group level, and the group can be the industry, the economy, a territory, or the world, if you like. And therefore we advocate for having an integration of different levels of analysis, and especially including the planetary boundaries in the equation when we think about the firm strategies. So we say that we need to incorporate macro level boundaries, we need multi-level theorizing, and temporal dynamics, which are things that we don't do enough in our field. Of course, if you had this idea that perhaps we are deriving false conclusions because of this ecological fallacy in the technical term, if I add the green, the ecological component as related to the environment, what is happening, keeping in mind that there is no path backwards, right? Well, what could happen is that when you evaluate the same type of diagram, let's change a little bit the axis, and let me put, for instance, embracing a geobiophysical exchange in planetary boundaries in the x-axis. What could be happening is actually we could, so what I just did, I just flipped the curve because most of us, or most of you, may think that the more a firm will go towards including these elements in their equation, the less profitable they will be. So that's why I just turn it, and so you have a downward slope. Even if you think that you have this downward slope, I redo this ecological fallacy, and you may find actually that some firms, and the firms that take into account the most these geobiophysical exchanges and planetary boundaries will be the one that will be more performing, right? So this idea is that the underlying value assessment of what makes a firm profitable, and you might notice that actually I put on as a y-axis performance, not just profitability, but performance, like maybe plural performance, meaning you have multiple indicators to define what performance is. You enrich this notion. It's of course economic efficiency, but maybe some other things associated with the impact, environmental impact, and others. Well, in that case, you will see that some of the firms are very good at doing the two together, and that the correlation or even the causality, if we can check it, will be positive. So I give an example with actually one company I'm involved, which actually a venture a capital fund I'm involved in. I picked this example because it's both Singaporean and French, and I'm, as I said, honored to be here with you today in Singapore. So the example is Shift for Good, And this fund invests in decarbonization in the transportation sector. It's Article 9, so it's a technical characterization in Europe for actually determining the most advanced. It represents about 5% of this fund in Europe that are the most involved in measuring their impact. And what this fund does, as you see here, is that of course, they try to meaningfully measure the positive impact on the environment of each of the companies they have in their portfolio. To do so, they have an impact committee, and I'm a member of this committee, which enable them to define the indicators that each and every firm in their portfolio must complete at time of exit of the fund. And 50% of the carried interest of the fund is tied to the achievement of these impacts. So you have here a tentative to actually associate both the impact, the materiality, so the two materialities within the fund, with the carried interest that is tied to these impacts. As an impact committee, we are completely independent. We discuss these different impact proxies, the KPIs, and the investment committee does its job on its side. So it's possible, probably, just to associate the two. So I'm moving on to the last point that I wanted to share with you. So again, double materiality is a new way, probably, of assessing a broadened risk-adjusted return function. What I said is that the ecological fallacy has plagued probably, at least the strategic management field, probably the investment field as well, but there are ways actually to address this fallacy. And now what I wanted to show is whether in the recent past we can find some elements, some cues, some facts, if possible, or signals that show that there is this shift, this progressive shift, and this questioning of the traditional shareholder value maximization or definition of what is the internal rate of returns for the different investments, right? And so I will share with you some of these elements. I will start by using an example from actually the actuaries. So the insurers are the ones that use very cautionary words, and so they are not the type of people who are just really using words without having weighted them very cautiously. And so this report is of January, so it's very recent. It's called Planetary Solvency, and this is an effort from actuaries to determine whether actually the insurance world is risky or not. So what they do, they have a tool like this. I will not describe it fully, but you see on the top that you have years. And what they do, they look at climate, nature, society, and economy, and do provide some trajectories in terms of the risk, because this is what they know to do. And so in 2005, you see that basically the C stands for climate, was in the yellow zone, the trajectory that was predictable. And nature was going in the what they call amber color. But that situation was, I would say, not so terrible. And this is what they did this year. So we are 25. And you see that now we have nature and climate, which are in the highly likely super severe risk. Economy is amber, society is amber, and here I magnified the text that you have on the left part of this diagram, and they say, and these are actuaries again, insurers, so when they put words, I mean, this is very cautionary made. Risk trajectory pushes all risk further out of appetite soon, with increased breaches of risk tolerance likely. Immediate policy action required to mitigate risk of catastrophic levels or greater impacts this century and possibly well before 2050. So that means that these people, I don't want to put words in their mouths, but what they are telling us that actually lots of the economic activities will not be insurable not by 2030, but by 2040, most likely. So we are reaching this systemic, I remember what I said at the very beginning, this vertical line, planetary boundaries, climate change, water, air, contamination, and all of this will actually jeopardize the capacity of the capitalist system to actually guarantee investments, etc. So I took also another example, which is the European Bank Authority that addresses this advice and recommendation, I should say, to the different banking institutions in Europe. Institutions should integrate ESG risk into the regular risk management frameworks by considering their role as potential drivers of all traditional categories of financial risk: credit, market, operational, reputational, liquidity, business model, and concentration. The time horizon is not 2050, it's 2035. And you should do this every year just to check, okay? They should monitor ESG risk through effective internal reporting frameworks and a range of backward and forward-looking ESG risk metrics and indicators. So the banking system is on check for that, and it's vital for its own activities, right? It's not just, we're not talking here just ESG as a possibility for adding some features about your investment capacity and assessing the risk or the collaterals or whatever you need, it becomes an obligation. And so that's why I entitled this, not so weak signals of changes in values in the way we will be valuing and assessing risks and economic value. And I take here 5 examples from academic research that combine together. Okay, so it's not smoking gun evidence that this is happening. I'm not presenting here causal association, I'm presenting correlational. But when we just start piling up all these different pieces of evidence, I think that there is an argument to make. So first, the long-term investors entice firms to disclose climate risk. So this paper is by Caroline Flammer, Mike Toffel, and Kala Vishwanathan. And what they say, they call shareholder activism. So it's not, it represents here what in their mind, the fact that some long-term investors, pensions funds, for instance, have some proxy or had in the past some proxies for general assemblies, for instance, for firms to disclose more of their financial risk, of their climate risk. Apologies for that. And so what they find, they say that environmental shareholder activism, as defined, I just did, increases the voluntary disclosure of climate change risks. So when these shareholders ask the firms about their policy, what will be happen, the climate policy or climate-related policies, these firms tend later on to disclose more information. So that means that long-term investors have an influence in making these firms change their behavior. They say here that the companies increase the voluntary disclosure of climate change risk by 4.6% following the submission of an environmental-related shareholder proposal, right? And what they say on top of that is that these companies that voluntarily disclose this information, post the proxies, well, what they did, they achieve a higher valuation post-disclosure. So that means they reveal some interesting information for the markets, and that increases their value. Probably because it helps investors to determine that their risk is reduced because they are taking this risk in consideration. A second element is the governance changes and the capabilities of firms actually to adjust to climate risk. So in this study from the Strategic Management Journal, by Xia Li, they look at the capacities that firms have to adjust to climate risk. And so what they do here, they do look at the capabilities using Refinitiv, one of the raters that do assess of a firm's impact, ESG impact. And what they find is that firms with better ESG ratings obtain capabilities that enable them to deal with the greater climate exposures. More so, they find that these capabilities are depending on the company's governance structure. especially if you have a committee that is related to sustainability. That will make you more likely to develop these capabilities and to react and adapt to the, for instance, operational risk associated with a flood or with drought or with value chain breakups, etc. And what is interesting, I think, is that to think that the corporate governance structures, the board structures, the committees, the associated expertise that you have with these governance structures is actually changing over the last 20 years. So the firms that include ESG metrics in executive compensation, for instance, have surged dramatically, right? So this is from an accounting paper where you see that basically it's not just European countries, it's 21 countries, 4,300 companies worldwide, 20 years, 10 years of data. So you see this increase. Why? I think it's not just a fashion. Is that because you need really to include this assessment of the risks to develop the capabilities to actually address and adapt to the climate change shakeups. A third point, if you look at banks and their behavior related to these considerations, what we find is that banks in credit activities, so just the simple activity of credit, seem to value positively these changes in governance. So another article from SMJ also shows that basically, so they define actually the cost of a credit through the collateral assets, the covenants, etc., that generate the financial cost of loans and credits. And what they find is that firms with boards in charge of addressing climate change problems can obtain less stringent loan terms. So even if it's like some basis points, that means that if you do this well, you can get access to credit at a lower cost, which is, from a strategy perspective, quite interesting. And so you mentioned, Yuxia, that in my some other occupation and position that I can have, this is something that we discussed, the fact that you can get access to credit, especially when you have, for instance, social or environmental targets that enables you actually to reduce the cost of your loans. The first point is market reactions to climate risk litigations. Okay. If these changes in trends as related to the planetary boundaries was not substantial, you could say that when you have actually prosecutions for animal mistreatment, for the biodiversity, contamination and pollution, natural land exploitation, and many other facts, probably the financial market will not react, right? So this study is quite interesting because actually it tends to show that the impacts of climate litigation on firm value is negative. So that means that the market react negatively to this. So specifically, they look at the hundreds of lawsuits against US and European listed firms between 2005 and 2021. And what they find is that firms experience, on average, a 0.4 fall in stock returns following a climate-related filing or an unfavorable court decision. So that means that there is this negative reaction from markets. Why? Isn't it interesting? If you look at this, at the top of this graph, you have so the vertical line is zero market reaction. You see that just the filing, so which is the center panel, is negative and statistically significant. Whereas the decision even more negative, and they describe here different subtypes of events, such as if you are a carbon major, I mean, the reaction will be more negative than if you are some other of the other firms. And if you look over time, the car in percent reaction, you see that you have like the market reaction on average to a favorable decision, so on your side, is 0. Basically, the dotted green line doesn't. So if you basically have the court in your favor, it doesn't change much your life. But the average negative reaction is clearly negative. So that's one thing that you can see. What I read in this diagram is something more that I think the authors don't mention specifically, is that if you look at the period after 2015, I would see that most of the dots are red and more negative. So I don't want just to make false inferences, but if I do the same thing from 2020 to 2030, I would have a tendency just to imagine that actually this will go the same direction or even worse, right? And the last piece of evidence, again, these are mostly correlational evidence, but still, is that there is a very intriguing question, which is the existence of a gremium in bond and stock markets. Gremium means a premium for being green versus the same vehicle or asset or product being brown, being with carbon. So Caroline Flammer has had this very discussed paper in the Journal of Financial Economics, where she says that basically the positive reaction of markets, that the markets react positively following the announcement of a green bond issuance. This is true especially for the first-time issuers and the issuers with the strongest non-financial performance ex ante. Okay. Also that the environmental performance of these issuers later on down the road actually improves over time. Okay. So you could say, yeah, okay, well, actually, basically, that's not so surprising since you have been seen and declared yourself as kind of green, that when you emit like a green bond versus a brown bond, if you are the same company emitting the two bonds, the green one will be better perceived. And so others have responded to this that, yeah, the thing is that same journal, Lubos Pastor and co-authors, say that, you know what is happening actually is that the green assets have lower actually expected returns than brown for two reasons. First, investors have green tastes, and greener assets are a better hedge against climate risk. So therefore, greener assets, lower expected returns reflects both a taste premium and a risk premium, right? And so it might happen that you have this gremium, but actually probably this gremium won't stand the long. And the comparison, once you integrate the potential confounding factors or endogenous factors that would explain in the first place that this company will have a green bond or a green stock. So what they say is that the value-weighted portfolio of stocks in the top third of greenness outperform the bottom third by a cumulative return difference of 174%, which is a lot, and that the green stock more strongly, perform versus the brown in the recent years. But they say, you know what? Actually, if you account for the unanticipated increase in environmental concern, this actually disappears. So what they do then, they correct for media reporting of lots of crises, etc., and they say basically that this effect dissipates once you adjust. So this is what you have here. Actually, the green stocks tend to outperform brown when there is a bad news about climate change. And we said if we set the climate shocks to 0, actually this effect disappears. The gremium disappears. They would even maybe underperform. Well, I go back to my two, principle at the beginning. So basically, they explain that this gremium is due to negative climate information. That although the expected returns of green products will be lower because you have this news, there is a bump in the demand that makes this product to be more pricey, and this is how they explain the gremium. What I'm saying is that with this, I don't think really that this climatic event will be unexpected anymore. I think that basically our forecast of the expected returns of these green products will be always, almost always, or will have like lots of time before to be actually correct in assessing the risk. So I don't stand so much with Pastor and his co-authors in the sense that because we are reaching the tipping points, because we are reaching systematic changes in the equilibria, this will be always this premium given to always. I mean, for some time, a premium for this asset, whether they are bonds or whether they are, company stock. Okay, so I am here, reaching the conclusion, right? So remember, this is the past. Double materiality as actually an adjusted, a broadened risk-adjusted return. The ecological fallacy that probably both from a theory perspective and models that include this multi-level and temporal assessment of the firm's of the consequences of firms' actions, and the pieces of evidence that show that the markets, the emitters, the markets, the governance of the companies, and the bankers, whether it's credit, whether it's equity, actually tend to show. I would say that I think that the double materiality is an attempt to create the condition for a market evaluation of this broadened risk-adjusted return function. I would say that the ecological fallacies, will be accounted for in models and practices. And I think, but this has to be demonstrated, of course, I pose this as a question as much as a sentiment here, that more signals and evidence that investing in sustainability-related assets will provide the best risk-return outcomes will become more the rule than the exception. Thank you very much for your attention.
Well, thank you so much, Professor Rodolphe, for your very interesting lecture. Actually, I'm so amazed by how researchers from different disciplines that examine the same question but with different angles. I really believe that we'll create so much more synergies if we combine the evidence together and then just have more dialogues with each other. Yeah. So now we move to the Q&A discussion. So our moderator today is Kenneth, who is the head of sustainability at Saviora and also director of ESG management at Citang Holdings, which is a PRI signatory based in Singapore. So Kenneth serves on PRI's listed equity advisory committee and is a long-time contributor to the sustainable investment community, both in Singapore and internationally. So he contributes a lot through international conferences such as PRI in person, and very impressively, Kenneth has been a very strong advocate for bridging theory and practice. So he engages a lot with academics, contributes a lot to our research conferences actually, and also in our classrooms at local universities such as NTU. So we're very looking forward to your reflections on Rudy's lecture and how you can help us better connect academic insights with your very rich real-world experience. So now, Kenneth, over to you.
Thank you very much, Professor Durand, for this very insightful lecture. And thank you to NTU, PRI, and ECGI for hosting this event for all of us. It's very great to see such a wide audience today. I was told by the organizers that we have almost 600 participants online, from investors to academics, as well as students. And what I've always appreciated about Professor Durand's work is how it connects the very big ideas of sustainability and strategy to real-world business decisions. And I really appreciate your profile, especially being the president of a purpose committee of a private equity fund and also sitting on the board of a listed company. So very much look forward to connecting with you. Now, one of the things that really stood out to me was, the whole concept about double materiality, as well as, your reflections on how the financial markets are already starting to price some of these signals, right? And that very much gels with what I see in my work as well. So I think today we'll dive into this more, right? And ultimately, I think these are very much not values-based questions and discussions, but they are really essential tools for better decision-making in business as well as investing, right? So maybe with that, let me dive in and set the scene with a few questions, right? So the first one I really wanted to talk about is around leadership and long-term thinking, given your very practical experience sitting on the boards, right? So, you know, with your experience, right, what has been some of the challenges working with some of these companies to get them to align their strategy on the board as well as the long-term thinking? And how any practical tips to get past some of the short-term pressures? Yeah.
So thank you so much, Kenneth, for this question and your words of appreciation. So that's true that I would say, and what I was trying to show, I don't know if I succeeded in doing this, is that you see very well that there is a connection between the finance world and the executives and the CEOs and executives in the company. And for me, the touching stone is really the board of the firm. So that means that how is it that the board actually takes care of both the interest of the shareholders, of course, but also the interest of the firm in and on itself. So it's very difficult for a CEO just to be able to apply a sustainable sustainability strategy without having the support of the board. And so you can see that you have some companies that were trying to push for this kind of strategy. You can maybe have some names in mind. I mean, Unilever, for instance, or Schneider Electric, and see how they dealt with the different events and pressures that currently exist in this domain. So Unilever having decided to reduce the objectives in terms of sustainability, and Schneider Electric having changed their CEO actually for going back on track with their sustainability strategy for a very, very longer term. So to your question, I would say it's really the capacity of the shareholders, but more so to the board, just to protect the firm for the long term. And if you buy in basically like the two main principles that I presented, which is the fact that we are reaching some non-reversible elements, that the firm should not wait too long before thinking about how to adjust to these different shocks, geopolitical, climate-related, etc. This is the role of the board to entice the CEOs, financially or not, just to consider this for the protection of the company. If not, you will have like some issues, problems. The value will be sacrificed. You will become a prey. Your balance sheet will be stranded. You will have stranded assets or some other, your balance sheet will shrink. You will lose some means, etc., etc. So a negative spiral for the survival of the firm. So long answer, but I think that actually is not so much in the CEO's hand or just the financial markets. Is the role of the boards to explain to the shareholders what should be done for the sake of the firm and the long-term performance of the firm.
Fantastic. Thank you so much. I think I'll just ask one more question and then we'll open the questions to the floor. I think there's already been some questions that have been submitted online. And clearly this was one very popular one. It's about the regional differences and approaches towards sustainability. And the one that people clearly had in mind was, the US is now on a slightly different path, a slightly different direction from Europe. So wanted to, ask for your reflections and your thoughts about the pathway. Related to that, there were also some questions about Asia and the Middle East. If you had thoughts on that, we very much welcome that too. Thank you.
Yes, I mean, these geopolitical changes are very interesting. I think that most of the territories and the regions are asking themselves, how is it that we can allocate the most efficiently possible the limited resources that we have and the capital that we have in order just to face these huge challenges that are in front of us. And so Europe, as I presented here, this double materiality is sort of like a European notion, has tried to connect the pressure on the finance world about reporting actually this risk that I showed with the EBA slide and put weight on corporations to assess their global materiality with difficulties. Let's not hide this, as you may know. And then for the same question of this capital allocation for these limited and rare resources, other regions may decide differently, right? So the US these days think that it's not part of the actually board decisions, investor decisions to embark this sort of associated risks in the economic activity, that the world is big enough for having, authorities of, regulators that will make their decisions when time comes, and this is not so much the time right now. My modest perspective on this is, I think that this cannot be really long-lasting, in a sense that it's probably like a pause on a general trend. Probably you got that from what I was saying. I might be wrong, I don't know, but this is what I think, because I think that they will have in a time not too far from now, which is to reintegrate these kind of assets, these kind of risks in evaluating their assets and their positions. And in Asia or Middle East, of course, this question of allocating the capital and address these limited resources, the common pool problem of depleting some resources for the benefits of only some and not for the benefit of others, can take different forms. So you have sovereign funds, you have more state-related directions that are given by different states. And so I would say probably one size doesn't fit all situations. It depends really of the natural resources of the place. What is it that you should protect? Is it the water? Is it the ground? Is it the air? What kind of long-term projections you can make for your own environment and your own population? Is it aging? Is it super young? You know that some countries have 50% of the population that are below 20. So I think that this equilibrium or equilibria to be found differ in different contexts. But I do believe you understood me that the pure market, free market allocation probably cannot, in due time, cannot alone actually respond to this consideration, because we need to have certain collaboration or collaborative mechanisms to include in these governance systems, because of the kind of problems we are facing. And that's why I was saying that you had like some shifts or changes in values, because what was true before for 50, or we could even go 150 years perhaps, the challenges that we have are asking us new questions and that we need to address in a way or another.
Yeah, thank you very much for that. Very much acknowledge that the world is changing with many different kind of risk profiles, from climate change, cybersecurity, geopolitics, and these are all things that businesses need to deal with, and investors need to deal with as well. And maybe just to share on additionally to what you said about Asia, I think we're very fortunate here in Asia, and as a practitioner in Asia, that a lot of the governments and the policymakers are taking this as really strategic business issues, strategic sustainable development issues for the country. So we are definitely continuing on this path. Maybe with that is an opportune time to open up questions to the audience. So I want to give everyone an opportunity. We also have participants online, but let's maybe start with the audience in the room. Anyone, please. Thank you. Maybe audience in the room, if you want, you can raise your hands. Yeah. Professor Matthew, please. Thank you. I think there'll be a mic coming to you, Professor Matt.
Okay, there we go. So you mentioned the board, and the board maybe being in the position to try to convince the CEO and shareholders to take action and recognize that we should be pricing some of these risks in. And I'm curious what you think of the arguments that some are making, that because there's this pressure to be Paris aligned, right? To try to make investments so that you are on like a sub 2-degree pathway. If you believe that we're not going to hit that 2-degree pathway, then if you're encouraging the firm to invest like that, you are over-investing, and so therefore you are actually, you're violating your fiduciary responsibility. You should basically be finding some other level of investment, but it's not 2-degree aligned. I'm curious if you've thought about that and what your reaction is.
Yes, so unfortunately the Paris Agreement, we all know it's already almost behind. So we will be hitting more probably 3.5 degrees more by the end of the century than 1.5. So that's true that it's an equilibrium to find as board members to decide which is the right level of investment. If you I would say you need to find with of course the executive team the right spot in which the action that you're undertaking guarantee the best adaptation and survival of the company. That's what I would say. So reaching a target, for the sake of reaching a target, I think is not, probably, in line here. It's more, what is it that we can do just to defend our business model, to guarantee that the company will be able to survive, to grow under the different constraints and pressure that we have. So completely ignoring the climate risk and all the other associated risk, I think it's a mistake, and it's not part of actually of your fiduciary duty. That because you need to, of course, guarantee the best return for the shareholders, and following, I would say, a bit blindly also some of these objectives without necessarily connecting them to your business model is also probably a bit too extreme. So it's a conversation just to have. You have in Europe, some companies that define their purpose and raison d'être in certain ways for the longer term. Even firms that are listed with a very fragmented shareholder base and that do pursue this policy with in mind the mid-term capacity of the firm to resist these different trends and challenges. This could be at a cost for the stock price a little bit. And if the chairman or the chairperson actually explain this to the market, I think that you may have like a little discount on the stock, but that could be appreciated, and and the people who don't want to invest don't invest, don't buy the stock.
Thank you very much.
And
I think we have
in mind
another
a specific company.
We have another question. Thank you.
Hi, this is Swati. Professor Durand, thank you so much for sharing your work and insight. I must say that as a carbon and sustainability professional, it gives me hope. It's fantastic. All the evidences and work which you showed, if it is true, of course it is true in that sense, but if we go by these evidences, as I said, it gives me hope. So if companies all over the world, if they're listening to it, watching it, or something like that, it's high time that they should start working on it. But that being said, I was wondering about a couple of points in terms of like these academic evidences. If you would be able to share a bit more on those things. So first point about the correlational nature of these evidences, and it's kind of a bit troubling. So these are not causations, right? So if we think about it, a company is being more profitable the moment they disclose climate risk voluntarily or something like that, or their profitability goes higher. There might be lots of other things, those are happening behind the scene, which we are not taking into account while reaching to this conclusion. So that is my first point. For example, the example would be that company is releasing a new product line, let's say, investing in something else, coming up with something else, and all of these things must be driving those factors. So that is my first point. The second one about, again, going back to these evidences. When we come up with this conclusion, are we taking into account, first, the size of these firms. Are we only talking about the big publicly listed companies? We're talking about the small SMEs and things like that. And second would be the type of industry and firms. Are we talking about something like oil and gas, textile industry, or something like that? The existence of these companies, these industry, is almost CO2, or something like that. So those things. Your insights, please.
Thank you. So I was maybe a bit undermining too much, perhaps, the results of these papers by saying that these are correlational. I mean, so they are correlational for most of them, but they do include controls in terms of the industry, the size of the companies. They do some matching techniques which help rebalance the unequal distribution of the characteristics across the firms. So although it's not, you know, lab experiments or randomized controlled trials, it's controlling from many of the factors that you were indicating. You also have, so for instance, in the Flammer's paper, the comparison between the same firm emitting different bonds. In the Pastor paper, you have they have a natural experiment with the German government that actually emitted bonds that are green and exactly the same bond without the green characteristics. So that enables you to control for many different factors. So they are as close as possible to a causal explanation. It's not. We cannot pretend this for most of the cases, but it's taking into account lots of the actually very well expressed confounders that you may have think of. So what I want to say is that this answer should give you even more hope.
Sorry, I think she has a second question. Maybe before we move to the next one. Did we answer your question, or did you have a second one? Okay.
Thank you very much, Professor Rudy, for a very insightful presentation. My question is around pricing or mispricing of long-term climate transition risk. So moving from the current equilibrium to the new future equilibrium, there will be challenges ahead. So what do you think would be a key challenge and opportunity for markets in terms of pricing of risk, especially long-term transition risk?
Oh, this is a very difficult question. Some of my finance colleagues tell me, you know, Rudy, I mean, that's very nice what you say, but actually you will have always, you know, because as the transition will go through, it will be more actually relative, I mean, just to invest in the broad industries because they become riskier and riskier, right? So that's one, of course, possibility. The other thing is that we regulate lots of public stocks, so that means the financial markets. You know that over the last 10 years, the sector that grew the fastest is the private equity, right? And they don't have the same kind of consideration for this. So this is beyond my knowledge and my competence, just to say whether actually private equity will discipline its own behavior and itself account for these different risks. So that's why I'm saying it's slowly shifting sort of values, and I put moral values in line. But you could have an argument saying that some private equity will just want to maximize based on the fiduciary duty, whatever, you know, and just take the dirtiest and the riskiest assets just to extract the most value out of it. So we'll see whether regulation at country level, at regional level, but you know, even larger, broader level will regulate this kind of behaviors. I would say I cannot imagine that this will not be the case, but for maybe a decade or so, that's true that private equity and other kinds of private, you know, investing vehicles could hedge their risks this way.
I think that's a perfect opportunity.
Maybe you can actually, I would be interested in your
absolutely.
answer.
So I think, you know, even in the private equity industry, especially the ones that have institutional capital or institutional clients, actually are expressing the same type of, you know, needs and requests similar to the listed market as well. So hopefully that gives some color and flavor, especially the ones that have institutional capital like pensions, for example. But on that note, it's actually perfect time to transition to some of the online questions. And I see quite a number of questions here around regulation, which actually is something you just mentioned in your last comment as well. And along the lines of double materiality, what is the role of effective regulation in helping to make some of these, or to help internalize some of these externalities into business consideration?
When there is this question around regulation, it always strikes me as if the proponents of the reduction of the regulations we're thinking that markets function without regulation these days. I mean, markets are highly regulated. I mean, the time you can make an investment, the time you can, share an information with the public, etc., is hyper-regulated already, right? So I don't want to say that I am in favor of extra layers of regulations per se. This is not what I'm saying. But what I'm saying is that with this change in values about what makes the right allocation, the right allocation right, there will be some movement. There are already some movements about integrating this additional element, not just the single materiality, but the effect that companies can have on the environment. You do even have some litigations about, in Bolivia, for instance, about the fact that a person actually attacked an oil company, assessing that this company over its existence was responsible for 49% of the warming, for instance, and therefore that, so that means that we can have this kind of elements and calculation. So for me, regulation is another way of helping the markets to find their optimal or as optimal as possible evaluation. There is regulation currently in markets, in high frequency trading or in regular market movements, and simply what we are saying is that to take into account the new reality, we will have just to change some of this regulation, to drop some and to add other. This is what I'm saying. So I see this complementary to the market efficiency.
Absolutely. Thank you so much for that. And maybe just to share a bit of the practitioner view as well, sometimes understanding a business's externalities can potentially help you get ahead of changing regulation as well, which when that regulation comes, then that would definitely be financially material, right? Maybe one more question online before we kind of close it off. Also related to regulation, they wanted to ask for your comments regarding EU Omnibus. Any thoughts or reflections on that?
Yes, so EU Omnibus, for the ones who don't know, is actually the recent passing of decisions just to slow down the acceptance and the implementation of some of the different legislation or the CSRD, the C3D, and others for different kinds of firms in terms of threshold, etc. So I think that probably based on what was happening in America and some geopolitical tensions that are associated with actually the uncertainty in the markets, volatility, therefore breakup of some value chains, rethinking of capex investments in assets, and the decision was made just to slow down. I think that my personal view is that, well, it was probably necessary just to have this being accepted, but I do believe that probably there was an overreaction from the different corporate world across Europe. There was a big fuss about the difficulty just to get access to the data to report all these points, data points. People said 1,200 data points that you have to report in your report. It was not exactly the case. For the first years, you could actually pick some of these ESRS on which you wanted to report. So I think that there was like a series of factors that combined together explain why this was probably, let's say, an acceptable decision to postpone a little bit from a practical perspective. From let's say, the urgency that the world requires, perhaps it's a bit regrettable. But if it's for a better good a bit later, let's do that. Let's do that. It's understandable.
Thank you very much for sharing that, and maybe again sharing maybe a bit more of an Asia perspective. You know, a lot of Asia countries are actually adopting the ISSB standards. So this whole idea about corporate sustainable reporting is becoming a reality globally as well. And maybe, you know, one final question just to wrap up everything, right? You know, given your experience and background, is there one piece of advice you would offer regulators and corporate decision makers who are looking to build long-term value in this new reality, as you mentioned?
So I have 10 minutes. No, only one word, so I will simplify. The best functioning and allocation of assets that we for markets that we had in the past, let's say, I don't know, century, is competition. Was competition, has been competition. I think that we need to combine competition with collaboration or cooperation for for a better good. And so we need to combine the two. Some states succeed in doing this. Some regions succeed in doing this. We need to consider this at a more global scale. I think that only competition cannot be, the alpha and omega for finding a solution. So at different levels, perhaps across firms. So of course, avoiding cartelization or this kind of thing. But what does it mean? Finding some, like for people who know Ostrom and the tragedy of the commons, polycentric governance systems, different ways of regulating our economic activities while protecting the initiatives, the entrepreneurial decision makings for people, but at the same time, when you are, if I deplete the common pool resource that prevent you from thriving, and that in the short term or even medium term, that will deprive myself from thriving, I think that it's a lose-lose sort of situation. So yeah, so that I would ask them just to try to think with academics, with investors, with practitioners, just to try to find this way of collaborating and competing at the same time.
Competition and collaboration, really a perfect note to close off this session. We're talking about sustainability, strategy, business, and investing. So thank you very much, Prof. Durand. And I'll hand the time over back to Serene. Thank you.
My pleasure. Thank you very much.
Thank you, Professor Rudy and Kenneth, for your very insightful discussion. And also, I'd like to thank the audience, both here and online, for your very critical and very relevant questions. So now, we would like to invite our Professor Marilyn Ang Uy, our Provost Chair in Entrepreneurship, and also the Head of Strategy, International Business and Entrepreneurship Division at NBS, to share with us her closing remarks.
Thank you very much, Yuxia. And thank you very much, Professor Rudy, and thank you, Mr. Kenneth, for tonight's event. Thanks especially for Professor Rudy's insightful and deep provoking insights on topics such as double materiality. And tonight's discussion has really illuminated and shown us the fundamental tension in traditional investment logic, where firms in their pursuit of profit maximization may inadvertently undermine the very conditions that sustain long-term economic, social, and environmental stability. Professor Rudy, your talk challenged us to reconsider the boundaries of responsibility in business and investing. We often assume that what benefits the firm automatically translates into broader economic and societal well-being. Yet, this assumption overlooks the unintended consequences of firm-level decision-making, whether in resource depletion, geopolitical instability, or other types of market issues. These effects do not simply dissipate. They accumulate and create systemic issues that ultimately affect and impact firms, investors, economies. So a key takeaway for tonight's session is really the urgent need for investors, for business people, for academics, for practitioners to rethink their risk assessment frameworks. Traditional financial indicators tell us only part of the story by indicating broader indicators, those that capture how firms contribute to or are exposed to macro-level disruptions. Investors can make more informed decisions and more forward-looking strategies. In this way, double materiality is not just a regulatory requirement or a major conceptual shift. It's a practical necessity for sustainable value creation. So as we leave tonight's discussion, I encourage all of us, whether we're academics, practitioners, regulators, policymakers, to reflect on how we can apply these insights in our respective fields. How can we embed a more holistic, system-based perspective into our financial and business decision-making? How can we ensure that firms and investors are not just reacting to certain issues, but are proactively shaping a more stable and a more sustainable future? With that, I want to extend my deepest appreciation once again to Professor Rudy for sharing with us his expertise, his experience, his research, and challenging us to think beyond conventional paradigms. And thank you everyone, whether in person or online, our audience, for being part of this wonderful conversation. Let's keep pushing the boundaries of how we define and measure success in business. Thank you very much.
Thank you so much, Professor Marilyn. Now, to express our gratitude for your very invaluable contribution to this lecture, we will now invite our Professor Junyang Ding to present mementos to Professor Rodolphe and Kenneth on the stage. So much. So to our audience, thank you so much for being part of our 4th NBS-PRI-ECGI Public Lecture, and we're so grateful for your presence and engagement. A heartfelt thank you to our dedicated organizing committee here at NBS and also online at PRI and ECGI. Your great work and dedication really make this smooth operation of the series possible. So our next lecture will be on 28th of May, featuring Professor William Tong from Cornell University, who will speak on a nexus of sustainability, financial markets, and also scientific innovation. So in this lecture, he will discuss broader impacts of sustainability policies, especially biodiversity policies. This lecture will be moderated by Eddie Chung, founder of Climate Plus, MU Investments, and also Amadio Holdings. So this lecture will again be in a hybrid mode. If you are in Singapore, we warmly welcome you to be here in Gaia. We will serve refreshments before the event. And of course, the lecture will be live streamed for our global community on Zoom. So to register and receive updates, please scan the QR code on the screen. We look forward to welcome you again next month. Before you leave, please take 1 minute just to fill out the feedback form on the screen or directly on Zoom. We really appreciate your honest feedback to continuously improve our series. So this marks the end of our event today. Thank you so much and wish you a wonderful rest of the day.